Hello and welcome to the Upgrade the World podcast. I'm your host Josh, and in this episode I'll be talking about stablecoins. For all the benefits a cryptocurrency like Bitcoin offers, its high volatility, meaning its high uncertainty related to the changes in its value, makes it poorly suited for day-to-day transactions. A stablecoin is a type of cryptocurrency that stabilizes its price by matching or pegging its value to another asset. The asset in the stablecoin issuer's reserve acts as collateral for the stablecoin. Whenever someone holding a stablecoin wants to cash out their tokens, they are given an equal amount of the asset from the reserves. Like Bitcoin, stablecoins are accessible to anyone on the internet 24 hours a day, 7 days a week. You don't need a bank account to hold stablecoins. They can easily and quickly be sent around the globe with low fees, and they are secure to transmit. The main drawback with stablecoins is counterparty risk. A stablecoin issuer might not actually have the reserves they claim, or can refuse to redeem tokens for their reserves if they so choose. Additionally, the entities issuing tokens might be able to freeze the stablecoins for law enforcement or other reasons. With stablecoins, you get some of the most powerful benefits of Bitcoin, but you are trading protection from counterparty risk for reduced volatility. To mitigate the risk, transparency and auditing of reserves becomes an important aspect of evaluating a stablecoin. There are 4 types of stablecoins: Fiat-backed, commodity-backed, crypto-backed, and algorithmic. Fiat-backed stablecoins generally have $1 in their reserves in cash or cash equivalents for each token in circulation. Most fiat-backed stablecoins have reserves of US dollars, but any other country's fiat currency could be used. Commodity-backed stablecoins are backed by physical assets such as real estate, oil, and precious metals. Gold is the most common commodity used to back stablecoins. These type of stablecoins make it easier to invest in commodities that might not be available locally. For example, one could gain exposure to gold without having to find a place to buy a gold bar and then find a secure place to store it. Crypto-backed stablecoins can be issued to launch an asset on a different blockchain. For example, wrapped Bitcoin, with the ticker symbol WBTC, is a stablecoin backed by Bitcoin, but issued on the Ethereum blockchain. Crypto-backed stablecoins are usually over-collateralized, meaning the value of the cryptocurrency held in reserves is more than the value of the stablecoins that have been issued, since the reserve cryptocurrency might also have high volatility. Algorithmic stablecoins rely on a complex set of instructions to keep their prices stable. The algorithm balances funds held on the blockchain with supply and demand using smart contracts to maintain price stability. Algorithmic stablecoins function like central banks, defending the peg of their currency in the market by buying assets when the price goes over the peg and selling them when the price drops below the peg. A different type of algorithmic stablecoin exists known as a seniorage stablecoin that doesn't hold reserves in smart contracts but instead has flexible monetary policies based on algorithms that increase and decrease the supply on-chain to maintain the token's price. The first stablecoin, Tether, was issued in 2014, and today there are over 200 stablecoins, with a total market capitalization of over $125 billion. Tether, with ticker symbol USDT, is a stablecoin owned by the Hong Kong-based company Ifinex Inc. Tether has become the most popular and largest stablecoin by market capitalization at over $83 billion. Tether is the largest cryptocurrency with respect to trading volume. It is pegged to the US dollar at a 1-to-1 ratio and is backed by cash and cash equivalents, precious metals, Bitcoin, corporate bonds, and other investments. The value of Tether's reserves is published daily and updated at least once per day on its website. The second largest stablecoin, USD Coin, ticker symbol USDC, was historically managed by a consortium called Center, which was funded by Circle and includes members from the cryptocurrency exchange Coinbase and Bitcoin mining company Bitmain. Given recent regulatory clarity with respect to stablecoins in the US and around the world, the Center Consortium will no longer exist as a standalone entity, and Circle is taking over issuance of USDC. USDC has a market cap of over $25 billion. Each USDC token in circulation is backed by $1 in cash or cash equivalents. Last month, PayPal, the well-known payments processor, announced the release of PayPal USD, with ticker symbol PYUSD, a new stablecoin issued by Paxos Trust Company, the first regulated blockchain infrastructure platform. PYUSD is pegged 1-to-1 with the US dollar and is backed by US dollar deposits, short-term US treasuries, and similar cash equivalents. Ensuring transparency, Paxos will release monthly asset reports and undergo third-party audits, with the first proof of reserve statement expected in September of 2023. PayPal plans to roll out PYUSD to US customers gradually, with a completion date of the fourth quarter of this year. That's all for this episode. Thanks for listening. And until next time, keep upgrading.